There is a lie that has been sold to an entire generation of investors. It's a subtle lie, whispered in the breathless headlines of financial news, screamed from the mouths of television pundits, and embedded in the very code of the algorithms that show you what to buy next. The lie is that the future, and all of its associated wealth, belongs exclusively to the new. It belongs to the disruptors, the innovators, the technological wizards conjuring revolutionary products from silicon and code. We are told that to achieve true portfolio growth, to find the path to financial freedom, you must be on the cutting edge. You must chase the next big thing, the company that promises to change the world from a garage in Palo Alto. And so, the average retail investor, the hopeful entrepreneur, pours their capital and their dreams into the same handful of high-flying tech stocks, participating in a global race to find the next digital giant. But while the world is looking one way, the greatest investor in modern history, Warren Buffett, has been quietly, methodically, and brilliantly looking the other. He has spent the last 60 years amassing one of the world's largest fortunes, not by chasing the future, but by mastering the present. By understanding the deep, unchanging and often boring realities of how the world actually works. His greatest secret, the principle that separates him from the frantic herd, is that the most powerful, untouchable monopolies are often hidden in plain sight, disguised as relics of a bygone era. Today, we are going to dissect this principle. We are going to expose the costly market mistake that 99% of investors make. And we're going to give you the mental toolkit to achieve a financial transformation in your own thinking. This is not just a lesson in stock picking, this is a complete paradigm shift in how you view the economy. We will journey through the 5 foundational pillars of Buffett's contrarian approach, starting with the story of a $44 billion bet on steel, wood, and dirt that revealed the ultimate fortress of physical reality. The year was 2009. The world was still reeling. The embers of the great financial crisis were still glowing, casting long, fearful shadows across the global economy. Confidence was a currency more scarce than cash. The Dow Jones Industrial Average had been cut in half. Iconic firms like Lehman Brothers had vanished, and the prevailing narrative was one of survival, not of ambition. In this environment of extreme fear, most investors were either paralyzed, selling everything that wasn't nailed down, or they were making timid, small-scale bets on a potential recovery. The world of high finance, the sophisticated practitioners of wealth management, were advising caution. They were focused on deleveraging, on risk mitigation. They were certainly not advising their clients to make the single largest investment of their lives. But Warren Buffett does not listen to the crowd. In November of 2009, from his famously unpretentious office in Omaha, Nebraska, he did something so audacious, so contrary to the fearful spirit of the age, that it sent shockwaves through the market. He announced that his company, Berkshire Hathaway, would be acquiring the entirety of the Burlington Northern Santa Fe Railway, the BNSF, for a staggering $44 billion. This wasn't a small strategic stake. This was an all-in bet. Berkshire already owned about 22% of the company, but now Buffett was buying the remaining 78%, paying a 31% premium to its last closing price. To the average observer and indeed to many seasoned financial analysts, the move was baffling. A railroad? In the 21st century? This was the age of the internet, of social media, of the smartphone. Technology was the future. Data was the new oil. Why, in heaven's name, was the world's most celebrated investor staking his legacy and a massive chunk of his company's capital on a 19th-century technology? A business of diesel, steel tracks, and physical grit. A boring, dirty, industrial business. The financial media scrambled for an explanation. Was this a sign that Buffett had lost his touch? Had the Oracle of Omaha finally become a relic himself, unable to grasp the new digital paradigm? But for those who understood Buffett's core philosophy, the move was not just logical. It was the ultimate expression of his search for an untouchable monopoly. It was a masterclass in value investing, a contrarian move of epic proportions. Buffett didn't see an aging relic. He saw a fortress, He saw an economic moat so wide and so deep that it was virtually impossible for any competitor to cross. To understand the BNSF acquisition, you have to understand the physical reality of America. BNSF owns and operates one of the largest freight railroad networks in North America. We are talking about over 32,000 miles of its own track, running across 28 states, primarily in the western United States. It's a sprawling, physical empire of steel, rail yards, bridges, and tunnels. Think about what it would take for a new company to compete with that. You couldn't just write some code or launch an app. You would have to acquire the land, the rights of way, through thousands of different municipalities and private properties. A process that would take decades and face insurmountable environmental and political opposition. Then you'd have to lay over 30,000 miles of steel track, build thousands of bridges, and bore through mountains. The sheer capital expenditure would be in the hundreds of billions, if not trillions of dollars. It is, for all practical purposes, impossible. BNSF, along with its primary competitor in the West, Union Pacific, forms a duopoly. In many regions, for many types of heavy goods, it is a pure monopoly. If you want to ship 1 million tons of coal from a mine in Wyoming's Powder River Basin to a power plant in Texas, you don't have a lot of options. You can't put it on a plane. It's too heavy for trucks to move economically over that distance. You use the railroad, you use BNSF, and you pay the price they ask. Buffett wasn't buying a technology. He was buying a permanent, non-replicable piece of the American economic circulatory system. He famously called it an, quote, all-in wager on the economic future of the United States. He knew that as long as the country grew, as long as people needed to eat food, build houses, and consume energy, goods would need to move from where they are produced to where they are consumed. And the most efficient way to move those heavy goods over land is, and will likely remain, the railroad. He bought a toll road on American prosperity. The psychological principle at play here is Buffett's profound immunity to what behavioral economists call recency bias and shiny object syndrome. Our brains are wired to give greater importance to recent events and to be drawn to things that are new, exciting, and complex. In 2009, the recent event was the financial crisis, which created a bias towards fear and inaction. The shiny objects were the burgeoning tech giants, companies like Apple with its iPhone and Google with its search dominance. The entire narrative of the market was focused on these two poles, the terror of the recent past and the glittering promise of the digital future. This cognitive wiring causes 99% of investors to completely overlook the mundane, the boring, the old. A railroad is the opposite of a shiny new object. It's a 150-year-old technology. There are no thrilling product launches, no visionary CEOs in black turtlenecks promising to change the world. Its business is measured in carloads and ton miles. This lack of excitement acts as a natural repellent to the majority of investors, who are constantly seeking stimulation and a compelling story. Buffett's mind works differently. He actively overrides this bias. He isn't looking for a story, he is looking for a durable competitive advantage. He understands that human psychology creates market inefficiencies. The collective obsession with the new causes entire sectors of the economy to be mispriced and misunderstood. While everyone else was chasing the ephemeral promise of the next great app, Buffett was focused on the unchangeable reality of physical logistics. He saw that the very boringness of the railroad industry was a key part of its strength. It meant fewer competitors, more rational pricing, and less public scrutiny. He exploited the market's psychological blind spot, its inability to appreciate the immense, quiet power of an irreplaceable physical asset. He knew that steel tracks embedded in the American soil were a far more certain bet than 1,000 lines of code stored on a server. So how can a retail investor or an entrepreneur apply this principle? You can use a mental model I call the irreplaceable asset test. This is a blueprint, a step-by-step process to help you identify these physical fortresses in your own stock analysis. Step 1. Identify the core physical asset. Don't look at the brand, the management, or the income statement just yet. What does the company physically own that allows it to generate revenue? For BNSF, it's the track network. For a pipeline company, it's the pipeline. For a cell tower company, it's the towers in specific, strategic locations. It must be something tangible and finite. Step 2. Calculate the true replacement cost. This is not the book value on the balance sheet, which is often a historical accounting fiction. You must perform a thought experiment. What would it cost in today's dollars to build this entire asset base from scratch? Consider the cost of land, materials, labor, and, crucially, the time and legal battles involved. For most companies with a true physical moat, you'll find the replacement cost is many multiples of its current market capitalization. This gives you a powerful valuation anchor. Step 3. Analyze the regulatory and geographic hurdles. Is there a formal government-granted monopoly, like with a utility company? Or is it a de facto monopoly created by geography and first-mover advantage, like a railroad? How likely is it that the government would approve the construction of a competing asset? In today's world of environmental regulations and not-in-my-backyard activism, the answer is often never. This regulatory wall is a key part of the moat. Step 4. Assess the network's indispensability. How essential is this physical asset to the functioning of the economy or a specific supply chain? Is there a viable substitute? For moving massive quantities of grain, coal, or chemicals, there is no good substitute for rail. This indispensability is what grants the company its pricing power. By running a potential investment through this 4-step test, you train your mind to see the world like Buffett. You begin to ignore the siren song of exciting narratives and focus on the bedrock of physical reality. This is a crucial skill for anyone aiming for long-term portfolio growth and beating the market. Now let's explore the antithesis, the path of the 99%. This is the path of the investor who is completely seduced by the story, by the shiny object, and who ignores the importance of physical, durable assets. The dot-com bubble of the late 1990s is the ultimate case study. Companies with no assets, no profits, and often no coherent business plan were valued in the billions of dollars simply because they had a .com at the end of their name. Take a company like Pets.com. Their business model was to sell pet supplies online. They had a memorable sock puppet mascot and a catchy marketing campaign. They raised over $80 million in their IPO in February 2000. Investors were captivated by the story of disrupting the old-world pet store industry with the power of the internet. But what were their assets? A website, some warehouses, mostly leased, and a sock puppet. There was no moat. Anyone could create a website to sell pet food. There were no regulatory hurdles, no irreplaceable physical network. Their only strategy was to burn cash on advertising to acquire customers, hoping to one day become profitable. Just 9 months after its IPO, Pets.com was liquidated. The stock went to zero. The investors who chased the exciting story lost everything. Contrast that with BNSF. The railroad's assets don't disappear if the market has a bad year. The steel tracks remain. The right-of-way is still owned. The bridges still stand. The business of moving physical goods continues. The path of the 99% is to value a compelling narrative over a durable asset. They buy the sizzle, not the steak. This mistake is repeated in every market cycle. Think of the SPAC boom of 2020 and 2021, where companies with little more than a PowerPoint presentation were given billion-dollar valuations. Many have since collapsed, wiping out retail investor capital. By ignoring the boring but essential industries, these investors are playing a game of musical chairs, hoping they can sell their story stock to a greater fool before the music stops. Buffett, by contrast, is not playing the game at all. He is buying the entire concert hall. Finally, let's trace the direct financial connection. How does owning a massive, irreplaceable physical asset translate into a tangible advantage you can see on a company's financial statements? First and foremost, it creates immense pricing power. Because BNSF operates in a duopoly, it doesn't have to engage in destructive price wars. It can raise its prices steadily, often at or above the rate of inflation, without fear of losing significant volume to a new competitor. This manifests as strong and stable gross margins on the income statement. Second, it leads to predictable and recurring revenue. The demand for moving essential goods is relatively stable through the economic cycle. While it may dip during a recession, it doesn't go to zero. This provides a level of earnings certainty that is rare in more competitive or faddish industries. Third, while maintenance capital expenditures are high, growth capital expenditures are relatively low. They don't need to spend billions building new cross-country routes. The network is already built. This allows the company to generate enormous amounts of free cash flow, cash that can be returned to shareholders or reinvested. For Berkshire Hathaway, BNSF is a cash cow, generating billions of dollars in dividends year after year. This single investment, this bet on the boring physical reality of America, has become one of the core pillars of Berkshire's financial empire. It is a lesson for every investor, from the beginner learning how to invest to the seasoned professional managing millions. The most powerful economic moats are not always found in the latest technology. Sometimes, they are forged in steel and laid across the earth. If the BNSF acquisition taught us about the power of physical fortresses, Buffett's next lesson reveals a different, more subtle kind of monopoly, one built not of steel, but of memory, emotion, and tradition. This is the story of how a small, family-owned candy company taught the world's greatest investor his most profound lesson about the power of a brand. It's a lesson that would fundamentally alter his approach to value investing and become the blueprint for dozens of future acquisitions. To understand this, we have to travel back to 1972. Warren Buffett and his partner Charlie Munger were approached with an opportunity to buy a company called See's Candies. See's was a beloved West Coast institution, famous for its high-quality boxed chocolates. The company was being sold by the See family for $30 million. Buffett, at this stage in his career, was still very much a cigar-butt investor, a student of Benjamin Graham. He looked for statistically cheap companies, businesses trading for less than their net tangible assets. He liked to buy fair companies at wonderful prices. See's Candies on the books was not particularly cheap. It had tangible assets of only about $8 million. The asking price of $30 million meant they would be paying a $22 million premium for something that wasn't on the balance sheet. Goodwill, the value of the brand. Buffett was hesitant. This went against his Graham-like instincts. Why pay such a huge premium for an intangible asset? It was Charlie Munger who pushed him. Munger saw something Buffett initially missed. He saw that See's was not just a candy company. It was a psychological phenomenon. He had observed firsthand how people in California were fanatically loyal to the brand. They wouldn't just buy any boxed chocolate. They had to buy See's, especially for holidays like Valentine's Day or Christmas. Munger convinced Buffett to take a closer look. They discovered that See's possessed a magical economic characteristic: pricing power. For decades, the company had been able to raise its prices year after year, consistently and significantly, without any negative impact on its sales volume. Customers didn't even flinch. Why? Because the decision to buy See's wasn't a rational calculation of price per ounce of chocolate. It was an emotional purchase. People bought it because their mothers bought it. They gave it as a gift to show affection and good taste. The brand was synonymous with quality, nostalgia, and tradition. It was a toll booth on human emotion. Reluctantly at first, Buffett and Munger agreed to buy the company for $25 million, a price the See family accepted. It turned out to be one of the most important investments of their lives. See's Candies became their lab experiment in understanding the economics of a great brand. Over the years, they continued to raise prices. Buffett once recounted how he would sit down with Chuck Huggins, the longtime CEO of See's, at the end of each year. Huggins would say he was thinking of raising prices by 10%. Buffett would ask, why not 12%? He learned that the brand was so powerful, the customer loyalty so ingrained, that price was almost a secondary consideration. The small $25 million purchase went on to generate over $2 billion in pre-tax earnings for Berkshire Hathaway over the subsequent decades, and it did so while requiring very little additional capital investment. It was an absolute cash-generating machine. See's Candies taught Buffett the difference between a good business and a great business. A good business, like the cigar butt companies he used to buy, could be bought cheap and sold for a one-time profit. But a great business, like See's, was a gift that kept on giving, a perpetual money machine you could own forever. This insight was a critical step on his path to financial freedom and building Berkshire into the behemoth it is today. The underlying psychological principle at work here is known as the affect heuristic, combined with the powerful force of brand loyalty. The affect heuristic is a mental shortcut where people make judgments based on their current emotions. When a customer thinks of See's Candies, they don't engage in a logical analysis of its ingredients versus a competitor's. Instead, their brain surfaces a wave of positive feelings: nostalgia for childhood, the joy of giving or receiving a gift, the feeling of a special treat. These positive emotions, or affect, guide the purchasing decision. The price becomes less relevant because the transaction is not just for chocolate. It's for the feeling the chocolate provides. This emotional connection, built up over decades of consistent quality and marketing, creates an incredibly durable brand loyalty. This is the moat. A competitor could open a store next door and sell chocolate of equal quality for half the price, and many See's customers would still walk into the See's store. Why? Because the competitor can't replicate the decades of emotional conditioning and personal history that customers have with the See's brand. Buffett learned that this kind of psychological moat, while intangible and not visible on a balance sheet, can be even more powerful and lasting than a physical one. A factory can become obsolete, a patent can expire, but a powerful brand lodged in the collective consciousness of millions of people can last for generations. This is a profound insight for entrepreneurs and investors alike. Building a business is not just about product and price. It's about building a positive emotional connection with your customers. To translate this into a practical tool for stock analysis, you can use a mental model called the pricing power litmus test. This is a way to diagnose the strength of a company's brand moat, just as a doctor would test for a specific condition. There are 3 key steps. First, perform a historical price analysis. Go back and look at the company's annual reports and investor presentations for the last 10 or 20 years. Has the company been able to consistently raise the price of its core product or service at a rate greater than inflation? If a company can only raise prices at the rate of inflation, it doesn't have true pricing power, it's just keeping up. A great brand can outpace inflation consistently without losing significant market share. See's Candies is the classic example, but you can see this in other companies like Coca-Cola or American Express. Second, apply what I call the gift test. Is this a product or service that people frequently buy as a gift for someone else? When people buy gifts, their decision-making process changes. The primary goal is not to get the best price, but to send a signal of quality, care, and good taste. You don't want to look cheap. This is why people will pay a premium for a Tiffany's box, a bottle of premium champagne, or a box of See's Candies. If a product is a popular gift, it's a strong indicator of a brand-based moat. Third, analyze the customer language. Go beyond the numbers and read customer reviews, online forums, and social media comments about the company. Are customers talking about price and features, or are they using emotional language? Look for words like trust, tradition, always, love, and reliable. This qualitative data can be a powerful clue that the company has built a deep psychological connection with its customers that transcends mere commerce. By using this 3-part test, you can begin to identify companies that possess the same magic ingredient that Buffett discovered in See's Candies. The antithesis of this approach is the path of the 99%, investing in or operating a commodity business. A commodity business is one where the product is essentially undifferentiated from its competitors. Think of a generic brand of milk, a ream of copy paper, or a basic airline seat. In these industries, the primary, and often only, basis for competition is price. The customer has no loyalty. They will switch from one brand to another to save a few pennies. This leads to a brutal, soul-crushing race to the bottom. Companies in these industries are in a constant state of price war, which erodes their profit margins and makes long-term profitability almost impossible. Imagine trying to start a new business selling unbranded gasoline. Your only competitive lever is price. If the station across the street lowers their price by 1 cent per gallon, you have to match it or lose all your customers. You have zero pricing power. Your fate is determined by the most desperate or irrational competitor in your market. This is the reality for thousands of businesses, and for the investors who back them. They are on a treadmill, running faster and faster just to stay in the same place. They have no moat, no protection from the harsh winds of competition. Buffett learned from C's that it is far better to pay a high price for a fantastic business with a powerful brand than to get a bargain price on a terrible, commodity-like business. The former will make you rich over time, while the latter will give you nothing but headaches and mediocre returns. This is a fundamental principle of wealth management and successful capital allocation. The direct financial connection of a brand moat like the one C's possesses is stunningly clear when you look at the numbers. First, it manifests in exceptionally high gross margins. Because C's can charge a premium price for its product, while its input costs, sugar, chocolate, labor, are not dramatically different from competitors, the profit on each box sold is enormous. You can see this directly on the income statement by comparing the gross margin of a premium brand company to a generic or commodity competitor. The difference is stark. Second, and perhaps more importantly, it results in a phenomenal return on tangible capital. Remember that C's had only $8 million in tangible assets when Berkshire bought it. The business did not require massive, ongoing investments in factories or research and development to grow. Growth came from opening new stores, which was relatively cheap, and from raising prices on existing sales. When you have a business that can generate high and growing profits with very little need for additional capital, you have found the holy grail of investing. The return on the net tangible assets employed in the business becomes astronomical. This is what Buffett and Munger mean when they talk about a wonderful business. It's a business that gushes cash. The lesson from the little candy shop in California transformed Buffett from a good investor into a legendary one. It taught him that some of the most powerful monopolies aren't protected by patents or physical barriers, but by the invisible, unshakable fortress of the human heart. We have explored the fortresses of physical reality and the toll booths of brand loyalty. Now we venture into a realm that is even more abstract, yet financially more potent than either. We are going to delve into the heart of Berkshire Hathaway's economic engine, into the strange and wonderful world of the insurance industry. This is where Warren Buffett found his ultimate financial weapon, a concept he calls the float. It is a source of capital so powerful and so misunderstood by the average investor that it has allowed him to build his empire over 6 decades. To understand it, we must go back to 1967, to a small, obscure insurance company in Omaha that would change everything. The company was called National Indemnity Company, or NICO. At the time, Buffett was still running his private investment partnership. He was looking for places to deploy capital. He learned that NICO, a well-run insurer specializing in commercial auto and general liability, was for sale. Buffett met with the owner, Jack Ringwalt, and within a very short time, a deal was struck. Berkshire Hathaway, then a struggling textile company that Buffett controlled, acquired National Indemnity for $8.6 million. On the surface, it looked like a small, unremarkable deal, but in reality, it was the single most important acquisition in Berkshire's history. It was the key that unlocked the kingdom. To grasp why, you must understand the beautiful, counterintuitive business model of insurance. It's the only business in the world where the customers pay you up front, and you might not have to provide the service or product for many years, if ever. Think about it. When you buy car insurance, you pay your premium today. You might not have an accident for 5, 10, or even 50 years. In the meantime, the insurance company gets to hold on to your money, this collected pool of premiums from all its customers, which has not yet been paid out in claims, is the float. Buffett realized that this float was an extraordinary asset. It was like an interest-free loan from his policyholders. He could take this massive, ever-replenishing pool of money and invest it for Berkshire's own benefit in stocks, bonds, or even buying whole companies. As long as the insurance company was run properly, this float would be a permanent source of capital. The genius of Nico, and the other insurance companies Buffett would later acquire, like Geico, was not just in collecting the float, but in doing so profitably. This is a crucial distinction. Many insurance companies lose money on their core business of underwriting. Their costs from paying out claims and administrative expenses are greater than the premiums they collect. They hope to make up for this loss by earning a profit on their investments. But Buffett insisted on a different standard: underwriting discipline. He wanted his companies to be so good at assessing risk that they would actually make a profit on their insurance operations before times any investment income. In industry jargon, he aimed for a combined ratio below 100%. A combined ratio of 95, for example, means that for every dollar of premium collected, the company pays out only 95 cents in claims and expenses, leaving a 5-cent profit. When you achieve this, something magical happens. Not only do you get to invest the float for free, you actually get tithes paid to hold the money. The float is better than an interest-free loan. It's a loan with a negative interest rate. This concept became the central engine of Berkshire Hathaway. The float from the insurance operations provided the fuel, the billions of dollars of permanent capital, that Buffett then used his stock-picking and capital allocation skills to invest. This dual engine, profitable underwriting plus savvy investing of the float, is the secret sauce that has compounded Berkshire's value at such an incredible rate for so long. The psychological principle that underpins the entire insurance industry, and Buffett's masterful exploitation of it, is hyperbolic discounting. This is a cognitive bias where people tend to have a stronger preference for immediate payoffs over later payoffs. We want the good stuff now, and we want to push the bad stuff off into the future. For example, most people would prefer to receive $100 today rather than $110 in a month, even though the latter is a better financial deal. We discount the value of the future reward hyperbolically. Insurance companies exist because people want to mitigate a future risk, a potential large later loss, like a car crash or a house fire, by paying a smaller immediate price, the premium, they are willing to pay today to avoid a potential catastrophe tomorrow. Buffett's genius was in recognizing the immense value on the other side of that transaction. While the consumer is focused on avoiding a future negative, Buffett is focused on obtaining a present positive, the cash. He has an exceptionally low time preference. He is willing to take on a distant, uncertain liability, the future claim, in exchange for a certain immediate asset, the premium, the float. He understood that the market and most people systematically undervalue this giant pool of investable capital because it comes with a corresponding liability on the balance sheet. They see the potential future payout as a bigger negative than Buffett sees the current cash as a positive. This difference in time preference, this psychological arbitrage, allowed him to see the float not as a risk to be managed, but as the greatest asset a company could possibly have. It was a river of gold flowing into his treasury, day after day. For the serious investor conducting stock analysis on an insurance company, this requires a specific mental model, the float quality score. Not all insurance float is created equal. Some is toxic, some is mediocre, and some, like Berkshire's, is pure gold. Here's a 3-step process to assess its quality. Step 1. Analyze the combined ratio history. This is the single most important metric. Look at the company's combined ratio over a long period, at least 10 years. Is it consistently below 100%? Does it stay below 100 even in bad years with major catastrophes? A company that can consistently underwrite profitably demonstrates incredible discipline and risk assessment skill. This is the mark of a high-quality insurer. If the ratio is consistently above 100, they are losing money on their core business, and their float is a loan they are paying for. This is a huge red flag. Step 2. Investigate the reserve adequacy. When an insurer writes a policy, it has to set aside a reserve of money it expects to pay out for future claims. A common trick played by low-quality insurers is to under-reserve. They make their current profitability look better by not setting aside enough money. The problem eventually comes home to roost, and they have to take a big reserve charge in a future year, wiping out profits. Look for a company with a history of prudent, conservative reserving. A sign of this is when they consistently have reserve releases, meaning their initial estimates were too high, and they can release that capital back into profits. This is a sign of honesty and discipline. Step 3. Assess the stickiness of the business. What kind of insurance are they writing? Some lines of business, like personal auto insurance, are highly competitive and price-sensitive, leading to less sticky customers. Other lines, like specialized commercial insurance for niche industries, which was Nico's specialty, are much stickier. The risks are harder to price, there are fewer competitors, and clients are less likely to switch insurers over small price differences. This kind of sticky business leads to a more stable and reliable float. By scoring an insurer on these 3 criteria, combined ratio, reserve adequacy, and business stickiness, you can determine the true quality of their float and whether it's a powerful asset or a ticking time bomb. The path of the 99% in this arena is to be the undisciplined underwriter or the investor who buys their stock. This is the insurance company that is obsessed with growth for growth's sake. They want to increase their top-line premium revenue at all costs. To do this, they slash their prices and write policies for risks they don't fully understand. They offer the cheapest car insurance, the cheapest home insurance, attracting the riskiest customers, a phenomenon known as adverse selection. For a while, their revenue growth looks fantastic. The stock might even go up. They are taking in huge amounts of cash. But they are making a terrible mistake. Their combined ratio is soaring to 110, 120, or even 130%. For every dollar they take in, they are promising to pay out $1.30. Their float is not an asset, it's a toxic liability. They are not getting an interest-free loan, they are taking out a loan at a 30% interest rate. This game can continue for a while, as long as claims don't spike. But eventually, the inevitable happens. A major hurricane hits a coastal area where they wrote too many cheap policies. A change in the law leads to a surge in liability claims. The house of cards collapses. The company is revealed to be insolvent, and the stock goes to zero. This is the fate of insurance companies that lack discipline. They chase the illusion of growth, forgetting that in insurance, the goal is not to write the most policies. It's to write the most profitable policies. Buffett's genius was in his relentless, lifelong focus on underwriting profit first. The float and the investment empire it enabled was the happy byproduct of that discipline. The direct financial connection of this strategy is what makes Berkshire Hathaway such a unique and powerful entity. It creates a dual engine of profitability that is unlike almost any other business. First, on the income statement, you have the potential for underwriting profit. When the combined ratio is below 100, the company's core operations are adding to the bottom line. This is the first engine. Second, you have investment income. The massive float, which shows up as a liability on the balance sheet, is invested in a diverse portfolio of stocks and bonds. The dividends, interest, and capital gains from this portfolio flow to the income statement as a second, massive source of profit. This is the second engine. For Berkshire, both engines are constantly running at full throttle. The insurance operations create profitable float, and the float is invested brilliantly by Buffett and his team. This creates a virtuous, self-reinforcing cycle of capital generation and reinvestment that is almost impossible to stop. Understanding the float phenomenon is not just about understanding insurance, it's about understanding the deep structure of Buffett's success. It was the discovery of this perpetual motion money machine, hidden within the boring and complex world of insurance, that provided the capital firepower for him to acquire dozens of other monopolistic businesses, from railroads to candy companies. It is the foundation upon which the entire empire rests. We've journeyed through moats of physical steel, emotional loyalty, and financial structure. Now we arrive at a fourth type of monopoly, one that is particularly relevant in the modern economy. It is a moat built not from a single asset owned by the company, but from the collective power of its users. This is the power of the network effect, a self-reinforcing loop that can create some of the most dominant and durable businesses on the planet. And Warren Buffett's masterclass in identifying this type of moat came not during a time of prosperity, but during a moment of profound crisis, a scandal that threatened to bring one of America's most iconic companies to its knees. The year was 1963. The company was American Express. The scandal was almost too absurd to be believed. It became known as the Salad Oil Scandal. A company in New Jersey called Allied Crude Vegetable Oil, run by a charismatic fraudster named Tino DeAngelis, was a major player in the vegetable oil market. Allied had a subsidiary that provided field warehousing services. This subsidiary would issue receipts for inventory held in its storage tanks, in this case, giant tanks of salad oil. American Express's own warehousing division accepted these receipts as collateral and, in turn, issued its own warehouse receipts, which were considered good as gold on Wall Street. Other banks and companies then lent money to Allied, with the American Express-backed receipts as collateral. The problem was, the tanks of salad oil were mostly full of seawater, with only a thin layer of oil floating on top. Tino DeAngelis had created a phantom inventory of over 1 billion pounds of oil. When the fraud was discovered in November 1963, Allied Crude immediately went bankrupt. Wall Street panicked. The banks and financial institutions holding the now worthless receipts were facing massive losses, and at the center of it all was American Express. The market feared that Amex would be on the hook for all the bad loans, a potential liability of over $150 million, a sum far greater than the company's entire net worth at the time. The stock collapsed, plunging by more than 50% in a matter of weeks. The consensus on Wall Street was that American Express was finished, destined for bankruptcy. This is where a young Warren Buffett, then managing his small investment partnership, saw an opportunity. While everyone else was panicking about the balance sheet liability, Buffett asked a different, more fundamental question. Has the underlying business, the core economic engine of American Express, been damaged by this scandal? To find the answer, he didn't just read analyst reports. He engaged in what is now famously called scuttlebutt research. He did his own primary, on-the-ground investigation. He went to restaurants and retail stores. He talked to cashiers and managers, asking if they were still accepting American Express cards and traveler's checks. They all said yes. Customers were still using them, completely unfazed by the salad oil headlines. He went to local banks and asked if they were still selling American Express traveler's checks. They were. He even talked to competitors. What he discovered was that the scandal, while a huge financial headache for the company, had done absolutely nothing to diminish its true economic moat, its powerful network. Buffett realized that the value of American Express was not in its warehousing division or its balance sheet. The value was in the millions of cardholders who used its products and the hundreds of thousands of merchants who accepted them. This created a classic two-sided network effect. A cardholder wants an Amex card because it's accepted in so many places. A merchant wants to accept Amex cards because so many affluent customers carry them. Each new cardholder adds value for all the merchants, and each new merchant adds value for all the cardholders. It's a self-perpetuating, virtuous cycle. The salad oil scandal didn't break that cycle. The fundamental desire of consumers to have a convenient payment method and the desire of merchants to attract customers remained intact. Convinced that the market was wrongly punishing the entire company for a problem in one small division, Buffett made one of the boldest moves of his early career. He invested 40% of his partnership's entire capital into American Express stock. It was a massive, concentrated bet. Over the next few years, as the company settled the salad oil claims for far less than feared and the power of its core business reasserted itself, the stock soared. Buffett's partnership made a fortune. This experience was formative. It taught him that a strong network effect is a type of economic moat that is incredibly resilient, able to withstand even the most severe and embarrassing corporate blunders. The underlying psychological principles that create and sustain a network effect are social proof and switching costs. Social proof is the tendency for people to conform to the actions of others under the assumption that those actions are reflective of the correct behavior. When you see that all of your friends are on a particular social media platform or that every store you go to accepts a certain credit card, you feel a powerful psychological pull to join in. You think, if everyone is using it, it must be good. This is herd behavior working in a company's favor. It drives adoption and creates a standard. Once the network reaches a critical mass, this social proof becomes an almost insurmountable barrier to entry for a new competitor. A new payment card, for example, has a chicken and egg problem. It can't get customers without merchants, and it can't get merchants without customers. The incumbent network is protected by the sheer weight of its existing user base. The second principle is switching costs. Once a user is embedded in a network, it becomes difficult, costly, or inconvenient to leave. For an American Express cardholder, switching costs might include losing a long credit history, giving up accumulated membership rewards points, or having to update automatic payment information for dozens of online services. For a merchant, switching costs might involve buying new payment terminals, retraining staff, and potentially alienating loyal customers who prefer to use that card. These switching costs, both real and psychological, act like a glue, locking users into the network and making the company's revenue streams highly predictable and recurring. So how can an investor identify a true, durable network effect? You can use a mental model called the Network Lock-in Checklist. It's a 4-point inspection to test the strength of a company's network moat. First, perform a two-sided market analysis. Does the company's platform or service connect two distinct groups of users whose value to each other increases as the network grows? Credit cards, cardholders and merchants, auction sites like eBay, buyers and sellers, and operating systems like Windows, users and software developers are classic examples. If it's just a one-sided product, it may have scale, but it doesn't have a true network effect. Second, evaluate the switching costs. Be specific and try to quantify them. How much time, money, and effort would it take for a typical user to switch to a competing service? Are the costs high and painful, or low and trivial? The higher the switching costs, the stronger the lock-in and the more powerful the moat. Third, ask the value accretion question. Does the service become genuinely more valuable for user N+1 simply because the first N users are already there? For a social network, the answer is an obvious yes. The 100th person to join gets more value than the 10th person. But for many businesses that claim to have network effects, this isn't actually true. The value proposition must be directly tied to the size of the network itself. Fourth, look for a data moat. Does the company collect proprietary data from the activity on its network that it can use to improve the service, which in turn attracts more users, who generate more data? This is a modern, powerful form of network effect seen in companies like Google and Netflix. Their algorithms get smarter with every user search or movie rating, creating a better product that's harder for competitors to replicate. The antithesis of a business with a network effect is what I call the empty stadium business. This is a company, often a tech startup, that sets out to build a two-sided market but fails to reach critical mass. They build a beautiful stadium, a well-designed app, a sleek website, a clever piece of software. They open the doors, but nobody comes. Or, a few people show up, but not enough to create the vibrant, self-sustaining ecosystem they need. Think of all the failed social media platforms that were supposed to be the Facebook killer, or the countless mobile payment apps that never gained traction. The problem is that a network effect business often has a binary outcome. You either achieve critical mass and become the dominant standard, creating a winner-take-all dynamic, or you fail completely. There is very little middle ground. The 99% of investors who fall for this trap are those who get excited by the technology or the concept, the empty stadium, without doing the hard work of assessing whether the company has a credible path to attracting both sides of the network in sufficient numbers. They are betting on the blueprint of a city, while Buffett is investing in a city that is already thriving. The lesson from the salad oil scandal is that when you find a truly dominant network, it's the thriving city that matters, not the occasional fire in one of the buildings. The direct financial connection of a network effect is incredibly powerful and shows up clearly in a company's financials. The first and most significant impact is on customer acquisition cost, or CAC. In the early days, a network business may have to spend heavily to acquire its first users. But as the network grows, the social proof and inherent value of the network itself become the primary marketing tool. New users join because their friends are on it, or because it's the industry standard. This means the company can grow its user base with progressively lower marketing and sales spending as a percentage of revenue. You can see this on the income statement, a declining line item for sales and marketing relative to a growing revenue number. The second major impact is on lifetime value, or LTV. Because of the high switching costs, customers in a strong network tend to stick around for a very long time. They are less likely to churn. This increases the total amount of profit a company can expect to generate from an average customer over their lifetime. A business with a low CAC and a high LTV is a recipe for extraordinary profitability. This powerful combination of falling customer acquisition costs and rising lifetime value is the financial signature of a dominant network effect. It creates a highly scalable and defensible business model that can generate immense cash flow for decades. Buffett's bet on American Express in 1963 was a bet on this very dynamic, an insight that the social fabric of the network was far more valuable than the numbers on a crisis-stricken balance sheet. We have now explored the towering fortresses of physical assets, the emotional toll booths of beloved brands, the financial alchemy of insurance float, and the self-reinforcing loops of network effects. For our fifth and final pillar, we turn to a principle that underpins all the others, a foundational belief that is perhaps the most misunderstood aspect of Buffett's genius. It is the simplicity mandate. This is the idea that the most durable, powerful, and understandable monopolies are often found in the simplest of businesses. In a world that fetishizes complexity, Buffett seeks a level of profound, almost brutal, simplicity. And there is no better illustration of this principle than the story of his acquisition of the Nebraska Furniture Mart and his relationship with its legendary founder, a woman who couldn't read or write, but could, in Buffett's own words, run circles around the Harvard Business School graduates. Her name was Rose Blumkin, but everyone knew her as Mrs. B. She was a force of nature. A Russian immigrant who fled to America in 1917, she arrived in Omaha, Nebraska, unable to speak English, and with a tag around her neck that said, "Find my son in Omaha." In 1937, with a loan of just $500, she started a small furniture store in the basement of her husband's shop. Her business philosophy was as simple as it was powerful. Sell cheap and tell the truth. That was it. That was the entire strategy. Mrs. B was relentless. She worked from open to close, 7 days a week. She was a famously tough negotiator, buying directly from manufacturers and squeezing every last penny out of the price so she could pass the savings on to her customers. She bought in huge volumes, piled the merchandise high, and sold it with razor-thin margins. Her competitors, the fancy downtown furniture stores, couldn't compete. They had high overheads and high markups. Mrs. B destroyed them. By the early 1980s, the Nebraska Furniture Mart was not just the biggest furniture store in Omaha. It was the single largest home furnishing store in the entire United States, generating hundreds of millions of dollars in annual sales from a single location. Warren Buffett had been a customer for years. He watched in awe as this single store, run by this indomitable woman, did more volume than all of its competitors in the city combined. He knew he had to own it. In 1983, Buffett approached Mrs. B, then 89 years old, about buying the company. The negotiation was legendary in its simplicity. He asked her how much she wanted. She named a price. He said okay. He wrote a check for approximately $60 million for 90% of the business. And here's the most incredible part. Buffett did not conduct an audit. He didn't send in teams of accountants to verify the inventory or check the books. He didn't hire lawyers to draft a complex, multi-hundred-page acquisition agreement. The deal was done on a handshake and a simple 2-page contract that Buffett wrote himself. He said later, "I'd rather have a handshake with Mrs. B than a 200-page contract with a lot of other people." Why? Because he understood the business completely. Its moat was not a patent or a brand in the traditional sense. Its moat was its maniacal focus on low costs, massive scale, and absolute integrity, all driven by the force of will of its founder. It was a business model so simple and powerful that it was almost impossible to compete with. The psychological principle that drives Buffett's preference for simplicity is a combination of cognitive fluency and the philosophical razor known as Occam's razor. Cognitive fluency is the idea that our brains have a preference for things that are easy to think about and understand. Simple ideas feel more true, more trustworthy, and less risky than complex ones. When Buffett can understand a business's entire model in a few minutes, he has a high degree of confidence. If a business requires a 100-page prospectus filled with jargon and complex formulas to explain how it makes money, he sees that complexity not as a sign of sophistication but as a sign of fragility. It means there are more hidden assumptions, more points of failure, more ways for things to go wrong. Occam's razor is the principle that states that among competing hypotheses, the one with the fewest assumptions should be selected. In investing, this means that a simple business model is inherently superior to a complex one, because it rests on fewer things that must go right. The Nebraska Furniture Mart's model rested on one giant assumption. People will always want to buy quality furniture at the lowest possible price. That's a pretty safe bet. A complex biotech company, on the other hand, might rest on a dozen different assumptions about clinical trial outcomes, FDA approvals, patent law, and market adoption, any one of which could fail and render the entire enterprise worthless. Buffett's simplicity mandate is a powerful filter. It protects him from the allure of black box companies where he cannot possibly understand the true risks. He knows that in the long run, simplicity equals durability. To apply this principle to your own investment philosophy, you can use a final mental model called the Explain It to a Child test. Before you invest a single dollar in any company, you must be able to pass these 3 hurdles. First, the one-sentence pitch. Can you explain, in a single simple sentence, exactly how this business makes money? If you find yourself needing multiple clauses, jargon, or and thens, you probably don't understand it well enough. For the Nebraska Furniture Mart, the sentence is, "They sell a massive volume of furniture for a tiny bit more than they pay for it." For Coca-Cola, they sell sugary syrup with a famous brand name for a lot more than it costs to make. If you can't state it that simply, it's a warning sign. Second, the durability question. Ask yourself, is it practically certain that people will still need or want this product or service in 10, 20, or 30 years? Will people still need furniture? Yes. Will they still drink soft drinks? Probably. Will they still use a specific niche enterprise software solution? That's much harder to predict. The simplicity test favors businesses that tap into basic, enduring human needs. Third, and most importantly, ask the competitor's nightmare question. What, specifically, makes it a nightmare for a well-funded, intelligent competitor to go up against this company? The answer must be simple and brutal. For the Nebraska Furniture Mart, the nightmare is its scale. A new competitor would have to come in from day one and match NFM's purchasing power, its massive inventory, its legendary low-cost structure, and its decades-long reputation for low prices. It's practically impossible. For many simple businesses, the moat is exactly this: operational excellence at a scale that is terrifying to replicate. The antithesis path taken by the 99% is to be drawn to complexity like a moth to a flame. This is the investor who buys into the black box company. They get excited by technologies they don't understand, business models they can't explain, and financial instruments whose inner workings are opaque. The quintessential example is the investor who bought complex financial products like collateralized debt obligations, CDOs, before the 2008 financial crisis. Very few of the people buying them, or even selling them, truly understood how they were constructed or the risks they contained. They were sold on a story of financial innovation and diversification, but inside the black box was a fragile system built on a mountain of bad assumptions. When those assumptions failed, the entire structure imploded, triggering a global financial meltdown. This happens in every cycle. Investors pile into speculative biotech stocks based on a single drug trial, or into software companies with convoluted revenue models, because they believe that complexity and a good story signal a high potential for reward. They are in reality just gambling. They are taking risks they don't and cannot understand. Buffett's simplicity mandate is his ultimate risk management tool. By refusing to play in games where he doesn't know all the rules, he avoids the catastrophic losses that wipe out most investors. He understands that it is far more profitable to earn a good return on a business you understand completely than to chase a spectacular return on one you don't understand at all. The direct financial connection of a simple, dominant business model like the Nebraska Furniture Mart's is its ability to create a sustainable, low-cost advantage and economies of scale. This is a fortress built on pure operational excellence. On the income statement, this appears in two key places. First, its massive purchasing power means it can negotiate better prices from its suppliers than any of its smaller competitors. This leads to a lower cost of goods sold (COGS) as a percentage of revenue, which means a higher gross margin. Second, its incredible sales volume from a single, highly efficient location means it can spread its fixed costs, like administration, marketing, and the cost of the building itself, over a much larger revenue base. This results in a lower selling, general, and administrative (SG&A) expense as a percentage of revenue. The combination of a higher gross margin and a lower SG&A percentage creates a superior operating margin. This isn't a temporary advantage, it's a structural one. The bigger the company gets, the stronger this advantage becomes. It is a virtuous cycle of scale. This is the simple, brutal, and beautiful math behind the business that Mrs. B built and that Buffett had the wisdom to buy and leave alone. It's the ultimate proof that in investing, as in so many things, the most profound truths are often the most simple. You have made an incredible investment of your time today, and in doing so, you have acquired a powerful set of mental tools. You now possess a 5-part framework for seeing the world as Warren Buffett does, for identifying the untouchable monopolies hidden in plain sight. You have learned about the fortress of physical reality, the unbreakable power of irreplaceable assets like a railroad. You have learned about the toll booth principle, the psychological moat of a beloved brand like See's Candies. You have uncovered the secret of the float phenomenon, the perpetual money engine of a disciplined insurance operation. You now understand the network effect monopoly, the self-reinforcing power of a platform like American Express. And finally, you have grasped the simplicity mandate, the durable advantage of a brutally efficient, easy-to-understand business like the Nebraska Furniture Mart. This is a complete toolkit for identifying the what makes a truly wonderful business. But a map is useless without knowing when to begin the journey. This toolkit helps you identify the world's greatest economic fortresses, but it doesn't tell you the secret of when to attack. How did Buffett know the precise moment of maximum fear was the right time to buy the railroad? How did he calculate the perfect price to pay for American Express when the world thought it was going bankrupt? Understanding the quality of a business is only half of the equation. Knowing the right price to pay, the specific market conditions to wait for, is the other half. It is the crucial link that transforms brilliant analysis into generational wealth. You have just mastered one side of the coin. The video that YouTube is showing you on your screen right now is not an accident. It is the other side of that coin. It is the missing piece of the map. It moves beyond identifying the great company and into the art of valuing it. It details the specific financial triggers, the market sentiment indicators, and the valuation methodologies Buffett uses to determine when a great business has finally become a great investment. It connects the strategic what you have just learned with the tactical when that ignites massive capital gains. Many people will stop here, content with the knowledge of how to spot a fortress. They will have the map, but never embark on the treasure hunt. But for those of you who are truly serious about achieving financial freedom, for the contrarian investors in this audience who are committed to building not just a portfolio but a complete mental arsenal, the next step is not a choice. It is a necessity. To complete your education, to bridge the gap between theory and profit, you must understand the trigger. Click on the video now and continue your ascent.